Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. We appreciate you being with us today. We're talking about commercial real estate lending, and our guest is George Ratiu. He's Director of Quantitative and Commercial Research with the National Association of Realtors, and we're on Skype, and we're talking about their report, Commercial Real Estate Lending Trends 2017. And George, one of the things our listeners and viewers ask us about, and I guess everyone's curious about, is what's really going to happen with the Fed's rate moving forward. You know, it seems like I hear conflicting things. We're going to raise it a couple times this year and 2 or 3 times next year, and then we hear, well, maybe not. What do you expect moving forward, and how might it impact commercial real estate interest rates?
Sure, and you're right. That's actually been the question of at least the last 2.5 years. Yeah. What is the Fed going to do? And when you looked at the Fed's statements during 2016, so last year, they were obviously quite cautious, and there was speculation they'll have maybe a rate increase in June, maybe one in September, but we didn't have anything until December, and even that was historic. It was only the second rate increase in a decade. But at the December meeting of the FOMC, we had, in essence, the chairwoman state that 2017 will see several additional rate increases. In March, we obviously had sort of a response to that. We saw another quarter basis point increase. And right now, I think the consensus is that this year we're going to see maybe a couple more. The Federal Reserve is obviously confident in the performance of the economy. They obviously looked at employment, economic performance, at inflation, and at least on the two main indicators that they publicly state are concerned, the unemployment and the inflation, we are in the target area where they consider raising interest rates. Interestingly enough, since we talked a little bit about global investors, globally speaking, some of the other central banks around the world are still very much engaged in monetary easing. We're actually seeing very low rates at central banks in Japan and some of the central banks in Europe, Switzerland, Germany, where the rates are still near the zero lower bound. So the Fed is somewhat, across advanced economies, divergent, and I think that speaks well to the strength of the U.S. economy, first quarter weak GDP numbers notwithstanding. So I think that from NAR standpoint and the realtor standpoint, we're expecting the Federal Reserve to basically increase the rate. So short-term rates should likely reach about 1.2%, 1.4% this year, and then another basically 1.6 or so by next year. How that's going to translate into long-term rates, which obviously are a lot more impactful for commercial practitioners, that's obviously a whole different question, in part because the short-term and the long-term don't move in lockstep. And we saw that with the 10-year Treasury. It certainly had a post-election bump. December, it closed at about 2.5%. It has since retrenched, and first quarter was averaging about 2.3%. And given that the cap rates are still about 6.8% on average in large cap markets, and based on our members' data, 7.5% in small cap markets, we still have a spread well in excess of 400 basis points.
So what would you expect cap rates to do moving forward? If we're going to have those type of rate increases, what would you expect on average around the country we might see for cap rate increases? And would you maybe see a higher cap rate increase in some of these smaller markets on some of the small cap properties?
I think that's a very good and astute question, in part because looking at cap rate movement, so in sense investors' approach to evaluating risk and properties, large cap markets have practically been flat. The national cap rate, based on data from Real Capital Analytics, has been at 6.8% for several quarters, including the first quarter of this year. In my view, and again, cap rates and 10-year treasuries or long-term rates don't move in lockstep, but I would expect cap rates to actually start moving up probably in the 10 to probably 30 basis point range. For some property types, even first quarter was actually noticed a small bump in cap rates, about 10%. So I would not be surprised to see for the rest of the year, again, depending on property types, another 20 to 30 basis point increase. At small cap market space, so in those secondary, tertiary markets, the cap rate has been hovering about 7.2, 7.4% for the better part of last year. The first quarter data showed an increase to 7.5, again, across all property types. So I think that in the smaller space, and for certain property types like retail, we're going to see a bounce in that cap rate that is likely to be probably in the 20 to 50 basis points going forward this year, particularly because in some of those small markets, some of the broad trends like the retail retrenchment are being felt much more strongly.
Right. Yeah, that's a good point. And, we're brokers, so maybe we're on a little bit of the front line, and we're realtors. We're already seeing cap rate increases on single tenant net lease properties, which most of those are, that small cap. They're $3 million to $800,000 or $900,000 even. And we're starting to see that asking prices, cap rates are starting to increase. Now, of course, as you mentioned, it's going to vary for different property types, but on some of these single tenant net lease deals, there's flat leases or there's no increases for 4 or 5 years, so it may impact those properties a little sooner, right?
I think so, and in fact, simply talking to members, just like you mentioned, basically triple net properties show up, single tenant properties show up because, again, not all markets are the same, not all property types perform the same, but to stay with retail for a second, while in large urban centers, let's say, a few Sears stores closing is not going to ripple too broadly into the larger market. For a lot of small and especially rural markets, the closing of a Sears, the closing of a JCPenney, in essence, that being the main tenant of possibly the mall in the area, in a sense, spells the demise of that particular mall. So obviously the entire ecosystem around that, whether it be fast food restaurant or otherwise, is likely to feel the impact of that much more disproportionately, in a sense.
Yeah, that's a good point. And, I hadn't really thought of that. Those single tenant net lease properties that are national credit tenants, they're typically low cap rates, but some of those will be in those markets where they're small enough that there's a major impact that all the people from those large geographic areas that may come to that small market to shop just aren't coming there anymore.
Exactly. And I think, a lot of talk about electronic commerce obviously impacting this. But to me, it was an interesting tipping point when we started seeing information in major news outlets, even this past year, that shopping habits of consumers on Amazon's own website started shifting towards everyday items. I mean, to the point where, for example, people are shopping for detergent, for paper goods on Amazon, something that normally they would go to the grocery store or to the big box retailer in their town or the region. So it's obviously that there are forces now putting a lot of pressure on some of these property types. And I think we're going to see that being translated into valuation and obviously into the cap rates that investors are willing to basically pay for some of these.
Yeah, well, that's interesting because, one of the stable property types there in retail has been grocery anchored centers. And you're talking about some of the staples that could bite into that a little bit. And I think another question our listeners and viewers have is the Trump impact, the new presidency. What should we expect for commercial real estate moving forward? What should we expect for lending moving forward? Stay with us. We'll be right back with that from George Ratiu. And this segment is brought to you by Xceligent, building data everywhere. Visit xceligent.com and stay with us.